All right, welcome back everyone to yet another daily video here, and today I wanted to cover everyone's favorite analyst, Mr. Dan Ives from Wedbush Securities. And Dan Ives is maybe one of the most prominent tech figures from the analyst side. I mean, he's constantly on TV, makes a lot of appearances, and he's known to be something of a hyperbull. So in today's video, I wanted to have a look at three of his price targets and kind of see what's going on with them, because what people need to keep in mind when it comes to Dan Ives, his job is not necessarily to be correct. His job is not necessarily to make you money. His job, to put it simply, is simply to sell an idea. That's how he makes his money. He doesn't have to be correct. There are always ways to pivot in case he gets something wrong, but he has chosen a strategy where he is seen as this extreme hyperbull with insane price targets. And the point of that is it gets people curious. It gets people asking, okay, what is Dan Ives seeing that others aren't? So he's, for these three targets that we're going to look at today, being Palantir, Tesla, and Apple, his price targets are the highest on the street, and that is by design. We'll mostly be talking about Palantir here because I want to discuss something interesting. I've been covering his price targets on the channel before, but there's a lot of new people. So a quick rundown is that he started covering Palantir in the 20s. So of course he's been, correct on Palantir in terms of the quote. However, the interesting part is that he will constantly raise his price target without there necessarily being anything underlying changing. So to give you an example, he had a price target for Palantir around $30. I don't know exact numbers now. It's been a year, but if you go back to a previous Dan Ives video, there will be the exact quotes and stuff. But in essence, he had a price target of $30. And he had a reason this is the Messi of AI. That was his initial selling point for Palantir. Yeah, this is the Messi of AI. They are doing these things with AIP. It's going to be great. Palantir goes up in stock price, and he puts out, a $60 price target, a month or two later. And it goes from 30 to 60. Same argument. Yeah, this is the Messi of AI. AIP is going to do great. So nothing really changed in his argument to, justify a double in the price target. But the only thing that changed was the quote. And another thing that changed is that Mariana from Bank of America also kept increasing her price target for Palantir. So there was this funny dynamic where Dan Ives would increase his price target, Mariana would increase hers above his. He would, one-up her, and then they kept that going up until, the 120s. And now, as we can see here in the Excel sheet, his current price target is 160, which is, pretty close to 151. I would not be surprised if this gets raised to, 180 soon. He always has to be a step ahead of everyone else, both Wall Street and the current quote, because that's what makes it interesting. So, he used to say Palantir is the Messi of AI. Then it became Palantir is going to be the next Salesforce. And, as a Palantir investor, the next Salesforce, what kind of target is that? It's going to surpass Salesforce. And by market cap, Palantir has surpassed Salesforce. So his new argument here, with his $160 price target, is that Palantir has a golden path to become the next Oracle. Now, Oracle has a roughly $680 billion of market cap. So, Palantir, close to 400 billion. They're kind of closing in on that. So we'll see. Is it going to be the next, Microsoft? It just keeps increasing. But the funny thing is that the underlying arguments for the company aren't necessarily increasing in his reports. I've read a couple of the Wedbush reports. Initially, I covered this in a previous video as well. Dan Ives would he would give a mathematical example of how he reached his price target. So he would say, okay, I'm putting this price to sales multiple on 2027 year's revenues. And that was like his reasoning. He had that for a couple of reports, but when you actually do the math and you apply the same multiple on that 2027 revenue, you would get something like a price target of like 22. I have the exact math in a previous Dan Ives video. I'm not gonna, redo that. But if you actually did the math that was written in the report, you would get something completely off, like way lower than the stock was trading and way lower than his actual price target. So I made a video on that. I made an X post, and then a report later it was gone. So now there's not even an mathematical example. Now it's just like these examples, like next Salesforce, next Oracle, used to be Messi of AI. So the whole point here is to keep people interested in what he's seeing that others aren't. So that's the whole idea here, and that's how Dan Ives makes his money. And he does a lot of appearances, and it seems to be doing really well. And in the case of Palantir, he's not even been wrong. I mean, he's been correct. Like, he's one of two Wall Street analysts, him and Mariana from Bank of America. They're the only ones that actually got Palantir. So I'm not trying to take away from Dan Ives. I mean, I think he really understands the narrative of Palantir. In particular, he understands the narrative of Tesla. So it's not that he's a bad analyst, but there is a lot of sensationalism tied to it, and a lot of it is on purpose. So with that said, it was kind of a long intro, 6 minutes, but let's do a funny, reverse DCF exercise. So his price target for Palantir is 160. Palantir is trading at 152. The Wall Street average is basically $95. So his premium to Wall Street is basically 69%. With that said, what does Palantir need to do today to be worth $160 per share fair value, intrinsically? And keep in mind, when Wall Street puts out price targets, they're not necessarily based on intrinsic valuation. They're typically priced. So they would say, okay, based on this multiple, our price target should be this within 6 to 12 months, sometimes 18 months, depending on the firm. But more or less, they are priced. They are not doing intrinsic valuation. So this is completely different from what they're actually doing, but it's still a fun exercise to see, like, okay, what does his price target imply? So to reach $160, what do we need to do? So first, let's assume a free cash flow to the firm margin for Palantir. Let's do something like 40. I think most people can agree that Palantir is able to reach 40 given how efficient of a company it is, capital light, all of that stuff that we usually talk about. And let's start with 30% revenue growth rate compounded and where that gets us. So with 40% free cash flow to the firm margins, 30% growth, we get $70 per share. That is way off from 160. So, okay, let's go to 40. And that's a big increase, like 10% actually does a lot when you compound it over a 10-year period. With 40%, we reach 140. Pretty close. We're not quite there. So let's increase it by 1% and see where that gets us. 150, so 42% compounded growth rate. It means Palantir will go from 2.8 billion of revenue in 2024 and reach 95.5 billion in basically 10 years. I believe that the margins are very, very likely, probably even a bit bearish. The growth rate, 42%, is quite high. I think I have something like, and I'm quite bullish on Palantir, I have something like 35% for Palantir. 42%, it's up there. And if we ponder the thought that he increases it by the next earnings, so something like $180 price target, compounding at 44%, that's $110 billion of revenue in 10 years, up from a base of 3. So the compounding effect really, a lot of interesting things happen, in the 40 plus range. So is this a sustainable path for Palantir, compounding at 42% at 40% margins? It's not impossible for Palantir. I think the Palantir really has to execute. They need to have international expansion on par or close to on par with what they're doing in the US. They need to increase their pace of acquiring customers. Those customers need to scale in that, close to 130% net dollar retention rate. With that, and NATO increasing defense budget spending, a lot of the DoD's budget going towards AI. When you combine all of those things, 42% is definitely a plausible scenario. It's not impossible at all. And 40% free cash flow to the firm margins is also very possible. So this $160 price target, not completely insane. It is difficult to achieve that given what we know today, but not completely impossible. However, keep in mind, this does not account for company-specific risk. So the discount rate in this scenario is market implied, which is 8.37%. So when you include some business-specific risk, I think I use 1.5% for Palantir. We get closer to $10 of 10% of discount rate. Then you actually need way more revenue growth, something like 47 maybe. No, 48. Yeah, basically 48% revenue growth rate, which means $144.5 billion of revenue in 2034. Now that one, given with what we know today, as of when I will post this video, I think this scenario is very, very difficult. But, market implied assumptions without that business specific risk, 42%. Can happen. And keep in mind, 69% premium to Wall Street on Palantir. Now, moving on to Tesla, the premium to Wall Street is also 69%. Is that a coincidence? I don't know. But similarly here, he is the analyst that has the highest price target for Tesla. He frequently talks about Palantir, frequently talks about Tesla. And he has an interesting quote that came out with this, which is, remains the most undervalued AI play in the market today. So let's have a look. So we need to assume some free cash flow to the firm margins for Tesla. Now, for a manufacturer, it is very difficult to have, those kind of Palantir cash flow to the firm margins of like 40, 50, 60%, that software companies can reach, the very best software companies. For a manufacturer, it is very, very difficult to reach that. But, let's give Tesla the benefit of the doubt. I think the coming years, they will be, scaling out manufacturing. I don't think they will, during the projection period, I don't think they will become very, very efficient yet. I think they're still like early stage. But if we give them like something like 8 to 10%, which is higher than they have been historically, let's start with 8%. What do they need to grow at to reach that $500 price target? And let's start with 20%. And keep in mind, they didn't really grow revenues year over year. But when it comes to Tesla, it is about the future. It is about autonomy. It is about the robo-taxis. It is about Optimus. But compounding over this 10-year period at 20% gives us a fair value per share of $200, which is not even half of Dan Ives price target. At 25%, we basically reach Wall Street's price target. So Wall Street kind of implying 25% growth and 8% margins. That would mean going from $98 billion of revenue going to 909.8 billion. A 10x in revenue over 10 years. So this 25%, it might not seem a lot, but when you compound it over 10 years, I mean, we're talking almost $1 trillion in revenue in 10 years. Now, that might sound completely plausible for the Tesla bulls who really believe in autonomy, really believe in Optimus, that every household will have like 2 Optimus robots. It's gonna, take over manufacturing floors, all of that stuff. And also that robotaxi will scale, people will use FSD. All of those things considered, 25% can, be possible. reaching that $909.8 billion of revenue. However, we're not quite at this price target. We're a bit over the halfway mark. How about 30%? 30%, we get to 420 and $1.3 trillion of revenue in 10 years. But we need a bit more. So how about 32%? No, still a bit more. So basically 32.5, yeah. 32.5 gets us to $501 fair intrinsic value, but it also gets us to $1.6 trillion of revenue. Now, for Tesla, I think it might be difficult over this projection period to reach 32.5%. Because I believe they're still kind of in the infancy. I think AI is just now starting to develop. I think it will have a pretty long runway. It might be a bit too soon to compound at this rate, from 2025 to 2035, reaching $1.6 trillion of revenue. But, some Tesla bulls might completely believe that this is plausible. But for me, this one is a lot less likely than Palantir. I think these Palantir numbers can really happen because we just know how powerful the scaling effect is of Palantir, how much value they actually provide to clients. But for Tesla, a lot of things have to go correctly for them to compound at 32.5% and be worth today $500 per share. So Tesla, if I'm putting this like on a 1 to 10, how probable it is given my understanding of these businesses. For Palantir, I would give it this like maybe a 6. I think it's more likely than unlikely, but it is close. For Tesla, I would give this like a 3 out of 10, given with what we know today. Robotaxis just launched in Austin. We don't really know how the scale out will be, what kind of numbers they're going to do. We don't know when Optimus is really coming. We don't know the adaptability of Optimus, how quickly it can reach global scale. We don't know any of these things, so it's really difficult to know if 32.5% is plausible or not. But given with what we know today, I will give it a 3 out of 10. Palantir, double that at 6. Now let's get to the worst one, which is Apple. The premium is only 14% compared to the street, and the reason is that India's supply chain situation that could now take the worst case scenario off the table for iPhone tariffs. So the bull case here is that tariffs are not going to be a thing. But let me tell you, like, tariffs are the least of my worries when it comes to Apple, because let's be generous here. Let's give them 30%, which is higher than they've been doing historically here. Let's give them 30% free cash flow to the firm margins. And let's see what kind of growth we need for Apple to, make this 270 happen. It's already trading at 212. Let's give them 5%. We reach 200. Basically where it is right now, and keep in mind, like, they have been flat or even declining in revenue recently. Like, they are having a really difficult time to keep up sales. So even that mid-single digit, really difficult in my opinion. But I think something like 10% is a bit too high. 9. So basically 9% revenue growth rate, almost at double digit. That's what Apple has to do at 30% free cash flow to the firm margin. I mean, I cannot see Apple growing at 9%. I think they are really stagnating, having difficulties even keeping their current revenue. They're declining. They are really fallen off in terms of innovation. They are behind on the AI race. They launched Apple Intelligence. It's completely behind every imaginable competitor. Despite being, the largest company in the world for so long, they really didn't, use that opportunity to do much of anything. iPhones are the same, I don't know for how many years in a row now, not really much happening there. MacBooks, the M chips are great, but it hasn't really led to this massive, growth rate. iPads are iPads. They launched this Apple, I'm forgetting the name, the Apple Vision, the AR goggles, they weren't a hit at all. So, Apple, where will I find that 9% compounded revenue growth rate? I really don't know. If I would be realistic, I would put Apple okay, let's say that they do manage to actually leverage their size and actually start to compete with their competitors, on the AI front, on, product innovation front. Let's say they give them 2% growth rate. I mean, to me, Apple is worth something around, $150 per share, roughly. This 270, I really don't know. I really don't know how the street sees 237 either. So if you're an Apple bull, please let me know in the comments, what are you seeing for Apple that will make them grow close to double digits over the next 10 years. I really don't see the vision as of right now, but who knows? It's Apple. They could come up with something. The ecosystem is strong. I use Apple products myself. I love Apple products, but they're really not growing. So in terms of probability of the price target, even though this is the least controversial one, remember the premium is only 14%. Palantir and Tesla both had 69% premium. For Apple, I would say this is like a 2 out of 10. I mean, I don't see this happening. Maybe I'm just this Apple hater, even though I love the products, but given the financials and the outlook and what they're actually been doing with the company as of, the past few years, I'm having a hard time seeing this, but who knows? Apple is kind of seen as a safe haven, this money park kind of stock. That's why I believe it's so high that it is today. But yeah, if you're an Apple bull, please let me know. But with that, we've covered, Dan Ives' 3 most famous stocks that he covers. Of course, Wedbush covers a bunch of stocks. They have a lot of analysts. It's not only Daniel Ives there, but he's, the most famous one, the face of the company. He's not that far off on Palantir. This can definitely happen, especially if we, let's say that they do 50% instead. Then we need something like 38.5, 39? Like 39% at 50%, or if we do 60%, then it's like, 36% at 60% margins. Still more likely than unlikely. Tesla, a bit difficult now, given that we don't really know the success rate. Definitely a plausible scenario. Apple, I don't see happening at all. So with that, I hope you enjoyed the video. I think it's fun, to talk about what analysts are doing, especially, high-profile ones like Dan Ives, how the narrative, steers everything. It's not so much funded in numbers. So a completely different approach to what I'm doing, but it's still interesting to, kind of backtest these price targets. So with that said, thank you so much for watching, everyone. Please like and subscribe if you have not already. Substack is available at research.typeofcapital.com, where you can get my valuations, my personal portfolio. We have some company coverage, equity research. A lot of stuff is gonna be coming here. So please check it out if you haven't already, and see you guys tomorrow. Bye bye.